Hello, and welcome to another episode of Passive Real Estate Investing. I'm your host, Marco Santarelli, and I have one of my great investment counselors on with me today. His name is Oliver Fu. Oliver, welcome to the show.
Thanks so much, Marco. Great to be here.
It's great to have you back on. It's been a while since I had you on, but
It has.
we're long overdue. We're long
Yeah.
overdue. So just to kind of tee this up so the audience knows what we're going to be talking about, and we're kind of kicking some ideas around. None of this is scripted. This is going to be completely, ad lib, I guess is what they say. But, we were talking about what are some of the more common real estate investor questions today, or, maybe to some degree, the more frequently asked questions. But, we're late in 2024. Mortgage rates have been up for quite a while. They've come down a little bit, and then, they've been going back up again recently. We just had an election, it's election year. And, I think today real estate investors have a lot on their minds, especially with the market dynamics shifting this year. Inventories are still low. Interest rates are still, relatively speaking, higher than what they used to be. But historically speaking, they're still pretty low. So I thought you and I can just get on and talk for 20, 25 minutes about some of the more common questions that you're getting today, because you're on the front line. You're talking to real estate investors every day. People are looking for help. They contact us because they want to know where to invest, what to invest in, should they be investing, all that
hmm
kind of stuff. So I guess maybe let me kick it off by, unless you have something to add to what I just said to this point, but I would probably kick it off by asking this. I hear people ask me, is now a good time to invest in real estate? And I have a canned answer to that. But before I say it, because I've said it many times on the show, let me throw it to you. Like, what do you tell investors when they say or ask you, is now a good time to invest in real estate?
That's probably one of the most often asked questions I get day in, day out for every year since I've been investing in real estate. Is now a good time? Is now the best time? And there's a couple of different answers to that. Number one is it depends. Depends what you're trying to do. Depends what your strategy is. Depends if you're trying to do something for taxes, for 1031, or if you're trying to purchase before year end, or if you're really trying to target that one property within that specific price range in that interest rate in order to cash flow a certain amount. So to answer the question is that it depends, but every single person I've spoken to just about always wishes they would have purchased yesterday, last month, last year, 5, 10, 20 years ago. They all wish they would have purchased before today. So is today the best day? Time will tell, but most of the time, I always get the same response, which was, Oliver, I wish I would have purchased when I first spoke with you 2 months, 6 months, a year, 2 years ago.
Right. Yeah. And, my response to that is, by the way, I hear kind of the same type of thing. I mean, nobody ever regrets investing in real estate over the medium and long term. They might have hesitation or mild regret if they invest in the short term because interest rates have gone down from when they invested, or maybe property values pulled back for a short period of time, a quarter, 2 quarters, maybe 1 year, but then started to appreciate again, and then their rents started to go up, and they started to see improvements in their returns, their cash flows, et cetera, et cetera. But short term, there's going to be ebbs and flows. Long term, nobody that I know has ever had a regret investing in real estate unless they made a mistake getting into a particular
Right.
deal because they invested in the wrong area, the wrong neighborhood, or maybe there were a lot of deferred maintenance items on the property and they didn't do their proper due diligence. I mean, that's I hate to say it, that's their fault, in many ways, because they just either didn't know what they were doing, or they didn't do proper due diligence, or they didn't have the right team around them to help guide them, hold their
Right.
hand, walk them through the process. But generally speaking, nobody long term ever regrets investing in real estate. It preserves wealth, it creates cash flow, it creates financial independence because of the financial freedom it ultimately gives you when you build a portfolio, and that leads to your time freedom.
And the
But
immense tax benefits that come from that as well. That one little disclaimer when I was at first answering your question was, as long as the deal makes sense from day one. That's the biggest criteria that I always try to uh, tell my clients, the deal has to make sense from day one, and that's really what helps set the foundation. Otherwise, if most of the time people that regret investing in real estate, it's because that deal did not make sense from day one. They invest in something that are too leveraged, or maybe just the numbers didn't pan out, but they thought it would because, California has been appreciating by X number every single year. So why wouldn't I put all my money in this one basket? For sure next year it's going to, go up 30%. And then the next year is going to go up and keep going up. And then I can just sell it and make a huge amount afterwards. That's what the mentality of a lot of investors, or, a lot of amateur investors might be. But those that have been in the game for a while think very differently about that.
Yeah, that's a very good point. And the thing I add to all that is this: it's to me, when someone asks the question, "Is now a good time to invest in real estate?" It's not about when; it's about where. Regardless of where interest rates are or mortgage rates are, there are always opportunities around this country. There's over 500 metropolitan areas that you can choose from, and there are submarkets and submarkets, and then neighborhoods within all of those markets. There are deals all the time peppered all around the country. Now, some markets and some regions are obviously better suited for investing than others because of price or inventory or availability or tenant landlord laws or whatever it may be. But there are always opportunities. There are always deals to be had. There are always properties that you can purchase that make sense the day you buy it, where it's well positioned. It's in a market that is not declining. It's a market that has stability. It's got jobs, potentially job growth, ideally population growth. So you've got sustained demand for that real estate. But if the property makes sense, it cash flows, or at least at a minimum carries itself. It may not have great or maybe any cash flow, that first year or two for whatever reasons. There are some exceptions and some reasons to that. But if you're in a market that is experiencing growth and is expected to experience growth and has cash flow, and you've got a property that can carry itself and it doesn't have deferred maintenance issues, that's potentially a good deal, maybe a great deal. But you'll find those almost all the time around the country. It's just a matter of knowing where to look and having the right team to help you make that acquisition or that investment. Did I miss anything? Do you agree? Do you disagree? You can push back on anything I said.
No, I agree with that. Having the team there is crucial. It's very important. And that team, one thing to keep in mind is sometimes that team does evolve, and you need to find additional contractors, maybe new property management companies, if ever, there's some sort of disagreement at some point in time. That team evolves in each market. So as your real estate portfolio, you know, evolves, maybe you need a new property manager. I don't know if this is like a pause or not, but if you want to get into property management, because I know that that's a huge topic that we can probably go into.
You bring up whatever you want. This is just like we're just kicking ideas and thoughts and concepts around, and who knows what's going to come out of our mouths. It's probably something that people who are listening or watching this are thinking about, or maybe will be thinking about.
Yeah, so what I was getting to with that is sometimes what I've noticed through my investing career, which is our investing journey really, which has been almost 14 years now, is I have changed property management companies numerous times across the board. Some property managers I've stayed with for many, many years, and other times I've had to um, change just because I've noticed that things weren't things weren't going well. The communication really fell off. Everything was going spectacularly well at the very start. Maybe when you have one, two, three properties with that manager, they can handle that easily. Once your portfolio starts to grow, things start to change. You really start to see how well that property management company can really tailor to what it is that you're needing as an investor in terms of communication, in terms of what you need payment wise, the efficiency of their teams, doing rehabs, turnovers, and everything else. It's things can change, put it that way.
So is that is that just because is that the bad excuse me, is that bad luck of the draw, or is
Uh,
it a good property gone bad, a good property manager gone bad, or is there another factor there?
there are a couple different factors. Sometimes it could be a property manager that started off, they might have had maybe 100, 200 properties to manage, and their growth trajectory just kept on going up and up, and they were adding 100, 200 properties per year. and they weren't able to have the sustained um, uh, in interior growth within the company to hire new personnel, to hire new employees, to train people up so that way they know what to do. Or maybe they tried different, I've seen this happen numerous times. They went to some conference and then they completely revamped their property management company, started having people within the company take over different roles that they never should have done to start with. And unfortunately, that causes a cascade of just um, I'd say frustration for the investor because now you're speaking with someone that doesn't know what it is that you're needing as an investor. They don't understand maybe the legalities around, for example, having squatters in a property, what to do about that, what the timelines are to get somebody out. Unfortunately, that's something that I've had to deal with. The property manager, and this is a little side story, the property manager for one of the properties that was being turned over, I had advised them to install an alarm system in the property as soon as the tenant was being evicted, which is unfortunate that the tenant was evicted. But so as soon as they left, we got confirmation of that. I informed the property management company right away, install an alarm system, so that way we would know if ever the door was open, there was any type of motion within the property, we would be advised right away. And then you have a very short period of time in which you need to alert the police so that way they can actually make it out to the property and take care of that situation and potentially get rid of the individuals that are trying to take possession of that property. Unfortunately, the property management company did not do that. They thought they did, but they actually never put an alarm system in there. And then come to find out, they call me up and they're like, hey, Oliver, there's somebody in your house that's not supposed to be there. They have a lease that's signed. They said that they sent someone the security deposit and the first month's lease, and the police can't do anything about it. This is now a civil suit, and you've got to take this to court and go through the proceedings. That whole process took about 9 months to get them out.
Wow.
Yeah, yeah. So anyway, so needless to say, when it comes to communication within that property management company is so crucial because when you have someone that's used to, for example, only doing leasing, only used to doing bill collections, or only used to doing maintenance, taking work orders or something along those lines, and then suddenly you give them the role of overseeing 50, 100, 200 properties because that's what they were taught at some management company or at some conference that would be the best potential way. You essentially force people into these roles. Sometimes that can really work well because it forces the individual to grow. But if that person at the company it doesn't have that type of capability, it unfortunately causes huge turmoil for the investor who has spent tens or if not hundreds of thousands of dollars of their capital into these properties to try and build wealth and build cash flow. But that's why, on my end, I've had to change property management companies a few times because I have noticed things like that occur. And there's a fairly distinct pattern that you start to notice in the management company before you get to that phase where they might end up selling off their entire portfolio to another management company to acquire, or maybe they end up closing up shop, or they just more or less force you to have to change as well. That's another potential too.
So, that kind of begs the question, how do you find a good property manager? And I'm sure many investors ask that question, whether to themselves or, to you and I. So based on that, your story and the question of how do I find a good property manager? What are some, high level suggestions or recommendations? We work with property managers in all the markets that we have rental properties in, like turnkey rental properties that clients purchase. But it's almost like the property management company is tied to those investments. Now, the investor or clients don't have to use that property management company. They could use their own property management company. They could self-manage if they want.
Exactly.
But the people we refer typically, almost always, come highly recommended. But for someone listening to this who's doing it on their own, how do they find a good property manager, or how can they mitigate those types of issues?
There's a couple of different ways to go about that, and I've seen this many times over the years. A newer investor typically will ask me for a property management referral in, Indiana or Indianapolis, for example. And we have two or three, and then they'll send that property manager a list of 50 or 100 questions to answer. And the property manager is like, listen, I can't really, we can't really do this. We don't have time to do this for everyone that wants to do that. So
Right.
there's a couple of, quote unquote gurus out there that say, here's my list, download this PDF, and I'll send you all the questions to ask every manager you
Right.
want. Well, the number of managers that actually want to spend the time with you to answer every single one of those questions is going to be challenging. Management is not, it's not an easy job. Can you still hear me?
Yes.
That computer. Okay. So property managing is not easy. It's quite challenging. You're dealing with a lot of people, a lot of personalities. Unfortunately, sometimes tenants, they get sick, they lose their job, they have to move, for familiar reasons. Sometimes, unfortunately, they pass away. That's happened, unfortunately, a few times at some of my properties. It's unfortunate, but the property manager, they deal with this stuff day in, day out, and they deal with people not paying rent. They have to go door knocking to ensure that, the property's up to par, that they're doing their inspections. I mean, the whole slew of things that the property management company needs to do. After doing this for so long, they're just on my side, just having a discussion with the property manager is crucial. Asking them, just your usual run-of-the-mill questions. How many properties do you guys manage? What's your usual turnaround when it comes to answering emails? What's the expectation when a property becomes vacant? What's your usual procedure for getting someone in there just to give me a scope of work? What does that usual timeline look like? How long? How many contractors do you guys have? Do you guys use in-house folks, or do you guys use third-party contractors that come in and do all of the work? So it really depends on on the property management side, how quickly you can actually get somebody on the phone versus are you needing to wait? I work with one property management company. I'm actually sort of surprised that that was a mosquito I was trying to side story, Marco.
You're fine.
You can only see this because we're on video today. We don't usually do video, but anyways, we're outside, sort of dealing with the elements over here. So going back to this, having that initial discussion with the property manager is crucial. I have one property in my portfolio that I have with this one property manager, and they do not ever answer the phone. I'm only with them because of one criteria that they have, which is they guarantee rent every single month, and I pay a very high property management fee. Um, I'll just tell you because we're here and we're talking about property management and real estate and everything else, but it's 20% property management fee. I think they've upped it to maybe 23 or 24% now because the program has gained some traction. But I wanted to give them a test phase to see how what the projections would look like if this scenario actually worked. It's this company. I'm not going to say its name right now, but they guarantee rent. They charge a pretty steep property management fee, but they guarantee that amount of rent will be deposited in your bank account minus their management fee every single month. In addition to that, they will also take care of any and all repair and maintenance items that come up during that month, as long as it meets a certain criteria upon initially onboarding with them in terms of you know more or less ensuring that everything is working at the property properly. They'll more or less cover just about anything and everything that comes up thereafter. So if it's a plumbing thing, if it's dishwasher goes out, or HVAC system needs servicing, they actually cover all of that.
They're
I've
covering
done
the expense, or are they covering
correct.
just their not just their fee? They're covering the expense itself.
They cover the expense itself. Correct.
Oh,
There's a
interesting.
there's a couple of things that they don't cover. For example, the roof. Um, but with this particular management company, they're very tech oriented, and I can. I can only get someone on the phone when I need to call into their emergency line. I had to do that a few times for some, tornado related things. But anyways, um, otherwise their schedule is out almost 4 weeks whenever I try to book with them online on their calendar.
Wow.
Yeah, so I was willing to give that a shot and see what that would, how that would turn out. And so far it's been a almost a equal. It's almost been a it's been similar comparatively. When I compare that to my other properties, where I'm paying anywhere between 8 to 10% in property management fees, compared to the 20% in terms of what my repairs and maintenance related items are for that particular year. Sometimes it'll be slightly lower, sometimes it'll be slightly higher, and this is within the same market. A very similar property profile, a single family home, 3-2, etc. Underwent the rehab in the same year. I've noticed that it tends to be very, very similar. So, am I going to continue with that, guaranteed rent scenario, offering that they're doing at the high property management fee? I think I'll continue doing that for a while until maybe I decide to, sell the property or do something different. But I like to test out different management companies, and so someone that has a portfolio as they start to grow their portfolio, they will, and this is what I recommend doing as well, especially if you're looking at alternative options for property management from where you're currently housing all of your properties. You can, when you're calling up new managers, start with one property. That's the other, I think, the pretty important thing. Start with transferring one property, see how that whole process goes. If it goes well, okay, continue on with the second one. If you transfer one property and you notice it takes 2, 3, 4 weeks to get an owner portal set up, to get your utilities online, to speak with the property manager, to get your PMA, your property management agreement, that tells you from the get-go what the most likely scenario will be in the future for your entire portfolio, and you then know, hey, I should look at a few other areas, and there are some markets where I do have a handful of properties in one market, and I work with 4 different management companies. So there are markets where I have multiples because I know that they're good in their own independent strengths, and at some point will I maybe merge them all potentially, but for now, things are
I,
it's a progression, put it that way.
yeah, and I think it's important to make sure that people listening to this understand that what you just described is not the norm. Like that management company, and what it sounds like to me, it's a form of insurance. You're paying a big premium on your management fee in order to have those benefits or perks. So it's very much like a kind of a rental guarantee insurance policy type of thing. That is absolutely not common. It's
That is
very
absolutely,
unusual.
it is very unusual, and there are some, I don't want, it's tough to say this online, but there in the past I've seen some companies where they have offered like a type of insurance on the rents, but in order for you to actually get a payout on those, it tends to be very challenging. And the payouts can take quite some time. There are a few companies that I'm aware of where you can purchase a type of protection plan, quote unquote. So if ever the tenant, for example, leaves the property without notifying the property management or the owner, or if unfortunately, if someone gets evicted, um, uh, then they will actually pay out up to a certain amount. Usually, it's about $1,000 or so, um, as a quote unquote insurance policy
Right.
on these, and those policies might cost you maybe $150 to $200 a year. But if you're on the verge of, unfortunately, there's been 2, 3, 4 months of missed rents from the tenant, and things are looking like, unfortunately, you'll have to go the legal route. Then it's a that $200 investment is well worth it. And then
Yeah.
yeah.
So for me, when it comes to finding a good property manager, if I can, just kind of summarize what it takes or what I would look for, one for sure is good communication, being responsive and thorough. um, to me, poor communication is one of my pet peeves. So no matter who I'm working with, but especially true for property management, I want to know that they're responsive, detailed, thorough, um, timely, and because they're really, my eyes and ears and boots on the ground. They're not just my property manager. I look at them as my asset manager. And so they're managing and responsible for taking care of my asset. So to me, it's one of the most important roles. It's a thankless job, but I want to make sure that they are responsive and communicative. So
Hmm.
for me, communication is a big, big one, and how they communicate is also important. Second, I want to make sure that it's not a one-man show. I've said this many times. I want full service property management. Good property management companies, in my experience, have been those that have different staff or individuals responsible for different things. Some of them are leasing managers, some of them are administrative and operations, and some of the people that work there are responsible for maintenance and repairs. They handle that role, that department, because for one person to try and juggle all that is very difficult, especially especially if you're trying to manage a large number of properties. You just can't scale, and things will just slip through the cracks unless you have
Very
the right
challenging.
team. Yeah,
Hmm.
you need to have a team, and everybody's got their area of specialty. So again, we can help you with that. If you're working with us, it's we've got property management companies that we work with all over the country, in the markets that we work in. But it's important to find a good property management company, and you can do the vetting yourself. um, we have referrals as well, but yeah, I mean, it's important to know. I mean, you want a trustworthy, efficient property manager. It's crucial.
Hmm.
You almost live and die by your property manager. So
And having expectations in place is very important from the get-go. Sometimes there are folks that expect a response within 24 hours or less. And if they don't get it, then they send follow-up emails, consistently until they get that response. So having and knowing what your property manager's communication style is like is very important. So that way there's no cross communication on that front, with what your expectations are, as opposed to what their usual standards and procedures are.
yeah, for sure.
Yeah.
I think another common question, you can almost chalk this up into like frequently asked questions, but this tends to change a little bit from year to year as the mortgage landscape changes. But how can I finance my investments? This is, the answer to this question is pretty much the same almost all the time. There's very few things that change. The variables might be interest rates, qualification criteria, maybe the types of mortgage loans that are out there. But I don't know how often you get asked the question, how can I finance my investments? But I think a lot of investors like to explore alternatives to the traditional loans, like the conventional loans, and they're out there. In fact, I just did a podcast episode like a week or two ago on DSCR loans, and there's different lenders out there doing property based, like debt service based loans, rather than
Hmm.
just you being the borrower and qualifying 100% for it, regardless of what the property is. um, do you have any thoughts or comments about financing and questions you get about financing properties today?
Yes. So just as a quick recap, in case this is a first-time investor that's listening to the show, every individual in America is allowed to have a total of 10 conventional loan slots, inclusive of your primary residence. If it's a couple, you can split that up into 20, 10 each. Again, it depends on the income and qualifications, assuming that both parties do qualify for those loans. And if you have a primary, for example, that's titled to both of you on the loan side, that would take up one loan slot for both of you. So then you would have nine loan slots for conventional financing each. Now, once you've exceeded that, DSCR is your next best route, almost every single time, and that's more or less just a debt. It's a type of financing that I think is in some ways a bit easier. It depends on the individual, but typically what the lenders will look at is simply your credit score. They want to ensure that they want to look at the last maybe 2 to 4 months of your personal bank statements to ensure that you've got enough funds in your account. And they'll also want to see what the property how the property performs, ensure that it does indeed generate maybe some form of cash flow, but that it is able to sustain itself. Those are usually the three main points for that type of financing. It's very easy, in my opinion. You can finance that directly through the LLC, which is typically encouraged almost 99% of the time. Um, it's, I mean, usually I'll also recommend that type of financing for some clients I work with that have very, very complex um, income structures. So they might, have
Right.
multiple companies across across the country, or maybe, across the planet, because they're involved in so many different types of businesses. They don't want to spend, hours and hours trying to put together this entire package for, conventional loan. Instead, we go the easy route where they just look at the credit score, bank statements, and the property, and that's it. So there's no tax returns, there's no W-2, there's no pay stubs, there's nobody asking you more questions about your personal finances. Now, the downside to DSCR type financing is typically, again, it depends on the season, but typically you'll be looking at about an eighth to a quarter, maybe even half a percent higher on the interest rate side. Again, it depends on the season though. In addition to that, sometimes the loan origination fees will also be a little bit higher. What I've seen a lot over the last, I'd say about 4 months, and it's actually continuing, it probably will continue until the end of the year, is that some DSCR lenders have decreased um, their um, their loan origination fees. So typical is about 2% of the loan amount. So for example, if you're putting 20% down on a house that's $200,000, so you're looking at $160,000 loan amount. So 2% of that would be $3,200. That's your typical loan origination fee on its own. That doesn't include anything else. So there's still there's still title insurance, there's still all of your usual types of closing costs associated with that transaction. So you'll be looking at a slightly higher overall closing cost, but also you're trading that off for the, in my opinion, the ease of being able to do this type of financing. But if you do qualify for conventional, that's usually your first step into this. For 95% of investors, they'll always first exceed or first use up all of their conventional loan slots, and once we've exceeded that, then we start going the DSCR route.
Okay. Yeah, that makes sense. I mean, the lending front doesn't really change all that much. The lending options have been pretty much more or less the same out there. The things that change are the mortgage rates, and then to a much lesser degree the qualification criteria. But those are pretty consistent. But there's definitely money to lend out there, and there's a lot of loan options. A lot of lenders want to lend on real estate because they love lending on
Mm-hmm.
real estate. Their loans are secured by the real estate. Um, it's a lower risk type of loan. So unless you have horrible credit, you should be able to get some sort of financing.
Right. And also the type of financing we're talking about here is more that traditional long-term amortized over 30-year type of financing. This is not suited for, this is a completely separate discussion if we were to have one about folks that are looking to flip or do the Burr type method or anything along those lines. That's a completely different realm, completely
Right.
different discussion.
Right. Um, do you get asked questions? I'm just thinking of like the more common questions today being 2024 or late 2024. I almost want to ask you what other common questions or frequently asked questions you're getting today that's more time, uh, more based on the year or the time that we're in rather than, just questions that are the same questions for the last 20 10, 20, 30 years. Are there any that, come out or um, stand out that you get more so now than before?
Uh, I've noticed that investors are paying a lot more attention to maybe their buying timeline and election cycles. The last two have been, I'd say, the few weeks prior to the actual election day, is very there wasn't much activity, put it that way, because a lot of folks I think were maybe hesitant or they want to wait and see what the election results would be before they decide to make their next move. But interestingly enough, a few days after the election and when the results were were released, suddenly, a lot of investors started to pick up the phone and call me, email me. There was a pretty significant rise in activity and
Right.
interest overall. So yeah, that's definitely been a theme for this, the end of this year.
Yeah,
Yeah,
that would make sense. And
yeah,
this
and
is not a
in
political show.
yeah,
What's
exactly. This is
that?
not a political show or anything along those lines. Um, and just like you, Marco, you've been around for quite some time doing this. And question for you: can you predict interest rates and what's going to be happening here for the next few months, or the next 6 months, or the next 12 months? What are your thoughts on that?
Well, nobody has a crystal ball, so nobody could really give you a true well, anybody can give you a prediction, but nobody can tell you definitively what's going to happen. Um, but you got to look at money flow and liquidity. If money is flowing into the markets, and more specifically the bond market, that is a very good predictor of whether mortgage rates are going to go up or down. It's not the Fed funds rate. It's not the interest rate set by the Federal Reserve. It's really the
Hmm.
bond market. If people are interested in bonds and they want to buy bonds and they're putting money into bonds and they're driving that market, that'll determine whether rates go up or down. What has been a surprise to a lot of people actually here in the last, I don't know, several months, or for a while, is the expectation was that mortgage rates would drop and continue to drop, and they did briefly, like this year for a little while. But then
Hmm.
they turned around and started going up, and everybody's asking the question, well, why are mortgage rates going up? But it's because people were feeling more confident about putting their money into bonds in the bond market, and mortgage-backed securities. So, and you can pull this up on any chart. You could just see the trend of mortgage-backed securities, whether it's going up or down. Um, and as that price goes down, if you read a chart, as that price goes down, the mortgage rates tend to go up. When that
Hmm.
reverses, you tend to see mortgage rates go down. So it's a very quick and easy, just kind of a dirty litmus test, if you will, to just see that is your predictive model. If you want a crystal ball, that's what you should look at to see or predict where mortgage rates are going to go. It's pretty accurate.
That's a great
But
answer,
yeah,
Marco.
what's that?
I said that was a great answer, very descriptive, and it also helps provide the listeners with something to be able to go and see what these what bonds are doing on a weekly, monthly basis, and that'd be more of a potential predictor as to where we're at.
Yeah, it's like in everything else. It's supply and demand. Like pricing, rents, interest rates, um, uh, commodities, currencies, all those things are driven by supply and demand. It's
Hmm.
just it's economics 101. It really is. People
Yeah,
overcomplicate things, but it's really supply and demand. So we've been running long. Let's
absolutely.
maybe
And
kind of throw. Go ahead.
I was going to say, just to touch on that as well, because interest rates are something that they come up very often in conversations because they do play a pretty significant role in terms of how a property will perform based on the rates that where they're at now compared to where they were maybe 2 3 years ago. But also let our listeners know that we do have in some markets some fantastic rates where our teams were able to work out a few things with conventional lenders, also some DSCR lenders as well. But you are still able to secure financing with 20 or maybe sometimes 25% down payment with rates that are still in the 4 and 5% range. So I think it's just really important for our listeners to hear that if they haven't heard that for a while. That type of financing is indeed still available on a 30-year note. So just to keep that in mind. So if that's of interest, definitely reach out to us because we still have those options available. I know most of them are doing it until the end of the year. What'll happen at the start of 2025? I'm not too sure if that program will still be around. I think it might, but I can't predict that definitively. So definitely reach out if that's of interest because to secure a property, even right now, at a high four, even mid 5% range on 20% down payment, I mean that's phenomenal.
It is. It's a great, great deal. People have to remember, it's always worth waiting and listening to the entire show right through to the end because often it's like a lot of golden nuggets and great tips and pieces of advice that come towards the latter part or towards the end of our show. So I'll drop one or two right now. Um, First, just uh, food for thought or kind of a frame of reference. People have to remember that the long-term historical average for mortgage rates, like if you go back 20, 30 years, excuse me,
Hmm.
30 to 40 years, is right around 7 to 7.7%. So, you just think about it. It's in the 7% range. That's the long-term historic mortgage rate. We've seen mortgage rates up into the 18, 19, 20% range back in the early 80s. So, you might think mortgage rates are, relatively speaking, high today, but they're not. We're in line with historic norms, the 30, 40-year long-term average. So don't think that mortgage rates are high or expensive. We're right in line with that long-term average. Second, this is kind of like the golden nugget, if you will. It doesn't matter what mortgage rates are. If the deal makes sense with the mortgage financing today, then the deal makes sense. It's worth getting because you're going to get all the benefits from real estate, the appreciation, the cash flows, the tax benefits, and all that stuff. If the deal makes sense, the deal makes sense. If the numbers work, the numbers work. It doesn't matter what the rate is. Just have to look at the whole picture, not pieces of it. You have to put the pieces together and look at the big picture. But then think about this. It doesn't matter whether your mortgage rate today is 7%, 8%, 10%. If mortgage rates goes down, you could always refinance it unless you have some crazy prepayment penalty, that doesn't make sense to refinance it. But if rates go down enough in a year or 2 years or 3 years or even 5 years from now, there's always going to be lending options where you can refinance into a lower rate, increase your cash flow, and do it. You can control the cost of refinancing, but you can do it by controlling the cost of that refinance. So it does make sense. It pencils out on paper, and you can lock in a lower rate. Now, granted, you'll reset your 30-year rate, like your term will
Hmm.
reset 30 years, but that's okay for two reasons. One, your tenant is paying your mortgage, and two, you're going to continue to create wealth and cash flow from that property, regardless of whether you have 20 years, 30 years, 40 years left on your mortgage. Third, if you really wanted to pay off your mortgage, you can accelerate your payments and you can knock that new 30-year mortgage down to a 28, 25, 20-year mortgage by adjusting how much extra principal you pay each and every month. So you can accelerate that and catch up to where you were if you really wanted to do that. So people need to think about financing in those terms. Does that make sense?
Absolutely. Makes a lot of sense. So the one thing to always ask yourself, you've heard it from me and from Marco, when you're purchasing a property, look at the numbers. Does this deal make sense based on the scope of work, based on, what was done to the property, based on the current projected pro forma of the home? Does this deal make sense? Yes or no? And that should, guide whether or not you decide to invest more time, energy, effort, and finances into that deal.
Exactly. Yeah, very well said. Cool. Well, Oliver, I think we've gone long enough. We've gone about 40 minutes or
I thought we were
so.
just getting started, Marco.
And believe me, there's a lot more we could talk about, but I think we hit some of the big ones. Some of the more common real estate investor questions today: is now a good time to invest? How can I finance my investment? What loan options are out there? Property management's a big one. It's kind of like a pain point for some people.
Mhm.
Um, uh, Managing risk, we touched on that. What else did we talk about? We um, I think we hit some of the big ones. I mean, we could always do a part
Yeah,
two and talk about other things, that we didn't cover today. But I think for the sake of time, we can just draw a line in the sand, cut it off here, so we're
yeah,
not going
yeah.
too long. But if listeners are interested in having a part two to this, by all means, email me It's Marco at Norada Real Estate or Marco at passiverealestateinvesting.com, or they can just go to the real estate website and just fill out the contact form. Of course, you could always go to the Ask Marco section on passiverealestateinvesting.com and just say, hey, I like the episode with Oliver. Let's do a part two, and then we'll have
That'd
you
be
back on.
great.
Yeah.
And also for listeners out there, if you're interested in, sometimes specific questions when you've built a portfolio, like how would you deal with X, Y, and Z? Sometimes it's hard to gain that type of insight and experience unless you've gone through it. And both you and I have gone through that. And unfortunately, I didn't have a lot of mentors when I was starting out with investing, and as I progressed through the years, a lot of it was through trial and error. And I find that now I really help with conveying that to a lot of the clients I work with. It works out, I'd say 99% of the time. The 1%, there are issues that come up no matter what, and that's one thing that I always try to also convey to investors is that sometimes when real estate can be very unpredictable at times. There are things that come up. I mean, I have countless stories of things that came up that I never in a million years could have thought that I'd be dealing with this particular type of situation. But that might be for part two, Marco.
Yeah, for sure. Well, that's good, Oliver. Hey, thanks for taking the time today. This has been a great conversation. It was, we didn't plan this. Wasn't scripted. It was just whatever came up, around that theme. And
Hmm.
yeah, hopefully it'll provide some value for people who are listening. So again, thanks for coming on,
Absolutely.
Oliver.
Thanks for having me, Marco.
All right. And if you're listening to this and you have any questions about real estate, investing, finance, whatever it is, you could always reach out to my team, including Oliver, but of course, always submit it at passiverealestateinvesting.com. Just click the Ask Marco button. And I do my best to get to all of them. We'll cover many of them on the show. And always remember, if you are listening to this and you haven't subscribed to the show, you click that subscribe button. It takes you like 3 seconds, and that way you never miss a weekly episode. We're actually publishing 2 episodes a week right now. We're doing Throwback Thursdays, where we cover a specific topic from the past that's still evergreen and pertinent today, just to kind of throw it back out there for people who don't know about it or have missed it. And other than that, if you give us a rating and review on iTunes, we greatly appreciate it. That is it for today. Thank you for listening. We will see you all on our next episode.